This recording is looking at Summer 17 question 4, focused particularly on section 1 of the syllabus around financial environment. So as you can see here, there's 3 separate issues, which is common in terms of the examiner approach to examining section 1. You have one very applied style area on the area of corporate governance. So recommend the changes that should be made for the governance structure of Arthur's. So again, in this case, you need to know what the best practice corporate governance is and be able to apply it given the information that's given. 10 marks. 6 marks for discuss why it's necessary for a business finance manager to have a thorough knowledge of the financial markets. And then finally, a small question on ethics for 4 marks. Given 2 particular scenarios, why does the actions appear to be in conflict with ethical principles? So we'll take each in turn. We'll talk down through each of them. Remember, it is a 3-hour exam, which is 180 minutes. So taking off roughly a half an hour for the start and the finish, you roughly around 1.5 minutes a mark. So we're talking about a half an hour for a question like this. So your first one here is recommend the changes that should be made for the current corporate governance structure of Arthur's. Now, corporate governance is probably one of the more technical areas in that topic one, that you do need to list out what is best practice corporate governance, and you'll have to refer back to the CAP1 report, which is the main instance here. So I'm assuming you've read down through the piece. So we'll just try and highlight some of the key things, and we'll see, well, why would the examiner tell us something like that? So first 2 things in the first sentence are, this is a PLC company, therefore it should be abiding by the corporate governance code. It's a listed company, it's a higher expectation, and it's in the tidal and wind energy section. All right. So what that means is, we have an idea why we're told what sector it's in, where we're probably going to have to discuss the skill set of the directors when we get to it. So we're told 18 months ago, the CEO and chairman of Arthur's, Pascal Devoy, stepped down, and into his place came Barry Hines. So that should be a red flag straight away, is best practice corporate governance means you should not have CEO and the chairman as the same role. So remember, you're asked for recommendations now. So first recommendation will be you need to split that role. There should not be one person with that amount of power, so splitting the role of Chief Executive Officer and Chairman to 2 separate people. So that's 1. So beginning there were some minor dips in the share price, but since then they have an aggressive acquisition policy and they seem to be going well. So there's no real issue with that. The fact that he resold companies making a profit is not bad corporate governance. It just suggests that they're making a good financial strategy and it's having good financial outcomes. Very pleased with its performance. The board is made up of 8 members, 6 of whom are executive directors and the remainder who are non-executive. Now that's another thing that should be highlighted. Best practice corporate governance. So again, you can be doing up your notes on this as well. The majority should be non-executive. Executive means they're working day to day. So your chief financial officer is an executive director. So they'll be on the board, but they also work day to day. Whereas you should have the majority of people should be non-executive. They'll come in 12, 14 times a year to discuss the performance of the board or the business. So Pascal pointed some time ago, based on skills and wealth of expertise in the field of natural energy, in particular solar energy. So you might have put a question mark there, again using the information that's given. Well, do we have enough skill set in tidal and wind energy? Just because it's solar may not be a good skills mix than what we need for this business. So a recommendation could be assess the skill set of your directors and make sure there's sufficient tidal and wind energy expertise there. So that's 3 or 4 recommendations. Another red flag, board of directors do not have regular contact with the company shareholders and they only meet irregularly. That's 2 big no-nos for best practice. 1, board of directors should have regular contact with the company shareholders, and that's all shareholders. And the board of directors should meet regularly. Regularly, they typically mean once every month. So there are 2 other practical recommendations you can provide. And even when they do meet, they do no more than a simple review of the performance, and they give Barry complete autonomy. Now again, that's poor practice as well. There should be comprehensive review of the business performance, not just a high level one. So they don't meet frequently enough, and even when they do meet, it's not sufficient. So for 10 marks there, you're looking at least 5 solid recommendations. Splitting the chairman and CEO, getting a majority of non-executive directors on the board, making sure your skills mix is appropriate for the type of business that you are, ensuring that there's more regular contact with the company shareholders, ensuring that the board of directors meet on a regular basis, ideally once a month, and when they do meet, that they do a comprehensive review of the company's performance and strategy. Don't just leave it to Barry for complete autonomy. So again, 6 points there. That'll be your full marks, 2 marks per point for 5. The second issue is linked to the last paragraph then. And what they're asking is, the shareholders have expressed extreme satisfaction with Archer's performance, but a minority have voiced some concerns about the growth strategy, because they're told up here they followed an aggressive acquisition policy in recent years. Concerned whether or not they have the finance to support the strategy and the risk exposure it faces. Board responds they're happy enough as long as the share price is rising. So what you're asked to do is, well, why is it necessary for a business finance manager to have thorough knowledge of the financial markets? Right? So if we go back and we think, well, what does a business finance manager do? So link it back. Well, the first thing a business finance manager does is the financing decision. They need to raise finance. So I'll make these a bit bigger. So they have to raise finance. So why would you want knowledge of the financial markets to raise finance? Well, the current state of the markets. So you want to know what's the current state of the bond markets or the stock markets if you're raising finance. So that's a very logical one, that if you're trying to raise finance, you want to figure out, well, is it a bull market we're in? Is it a bear market? Is it the right time to raise finance? You want to have an idea of what the cost of finance will be for different sources. So if you don't know about the financial markets, you don't have an idea what's going on, you're not going to know what the cost is and which one is more attractive. And I suppose you're not going to be able to make informed decisions in terms of capital structure. So you're not going to be able to make a good finance decision because you won't know what's going on. You won't know the cost, you won't know what the market sentiment is. Once you raise the money, of course, the next decision is your investment decision. Invest the money. And again, you need to have an idea of what the state of the financial markets are. You need to make informed capital investment decisions. So if you don't understand what state the market is in, so for example, if we're in a boom, or you can call it a bull or a bear market, will impact investment decisions. So a bull market is things where things are very positive, there's a lot of optimism. Or a bear market is when there's, think a recession is coming, there's a lot of fear in the market and anxiety. But that will impact investment decisions. You're not going to make huge, big investments if you think there's a bear market coming and there's a recession, because people are very anxious and there's a lot of fear spreading in the stock markets. And finally then, of course, when you're looking at the dividend decision, you want to have an idea of the financial markets is, do people want, what dividend policy do they want? So how will markets react to dividend decisions? So certain companies, if you announce a dividend decision that the market reacts poorly to, that can damage your share price. So you can see what we're looking for here is, think about what a business finance manager does. They raise money, they invest money, and they hopefully return money through dividend decisions. And then think about, why do you need to know about these financial markets? Because otherwise, across all three, you'll make poor decisions. You won't know how much money to raise, how much it'll cost you, you'll invest at the wrong time, and you may decide to return money to shareholders in the wrong format. So what you were looking for there was 6 marks. You're probably looking at 6 nice points. 6 solid points should get your marks there. We're not looking for big S's, just short, snappy bullet points. And the very last question is around ethics. Now this is a very specific thing around ethics. They're talking about chartered accountant ethics. Rather than managerial ethics in general, they're talking about what ethics or ethical values does a chartered accountant have to obey. Now whenever this type of question comes up, the first thing you'll always should have in your study pack is have a quick look. Now it's a long document, but just have a look at the Code of Ethics for Chartered Accountants Ireland. And in particular, I want you to look at page 7. These 5 key principles, or the fundamental principles. That if you know these 5, most ethical questions in CAP1 will cover this. So a professional accountant should act with integrity. That means they should be straightforward and honest. They should act with objectivity, meaning they shouldn't be biased or conflict of interest. They should be objective in terms of their decision making. They should have professional competence and due care. What that means, they should ensure that they're up to date with the relevant international accounting standards, the relevant legislation, and they should take due care when applying that knowledge to their work. They should maintain confidentiality. So what that means, if you're an employer and you have employees, those employees should not disclose trade secrets outside the company. Or if you're a professional accountant, you should not disclose the confidential information of your clients to third parties. You're breaching that confidentiality principle. And finally, then, more of a catch-all term, you should act on professional behaviour. You should avoid anything that discredits the profession. Now, naturally enough, the whole idea of breaking the law, fraud, etc., that's all breaching professional behaviour. And these 5, even if you just list them down, they're the ones to watch for in a lot of these ethical questions. That if you're a professional accountant and you're found to breach these, you can be removed from your qualification. So it does have implications if you don't meet those standards. So the 2 particular questions or scenarios we're asked for here is, an accountant prepares a set of accounts before undertaking the audit. So clearly here what's happening is you're going to be auditing your own work. So that is what's called a loss of objectivity. It's clearly going to be a conflict of interest. How can you audit your own work? Because an audit should be independent. So you're breaching the whole idea there of objectivity. The second one then is a director discusses an impending share issue with colleagues at a country club gala event. So this whole idea here is the breach of confidentiality. If you're a director, an impending share issue is a very important commercial event, and you should not disclose this commercially sensitive information to third parties, because again they could trade on that information. So you're breaching your confidentiality principle there. And this particular type of scenario could also be known as insider trading, where you give insider information to other people to trade on that information to make money. And that's illegal as well as being unethical. So just have a little summary sheet. If you're asked about a chartered accountant, the whole idea of the ethics around chartered accountant, you're looking at those 5 principles from the Code of Ethics. Sometimes in CAP1 Finance they'll ask you ethics from a managerial perspective, or sometimes they'll ask you from the professional accountant's perspective. So that was a nice short question. You've roughly a half an hour to complete a question like that. You may not need all of it if you know your material, and you can save some time to complete your calculations on the paper as well. So Summer 17 question 4 focused particularly on topic 1, financial environment.